All right, Joel, didn't mean to cut you off there.
No. I'm just gonna say the difference between the Kohl's deal and the Activision deal
Didn't
is
see that.
regulatory concerns, right? So
That's
no
fair.
one's gonna care if Starboard takes over. So that, I just wanted to draw the distinction between those two. But let's bring in Tim. Hey, Tim, how you doing?
Good. How are you guys? Nice to see you.
Excellent.
Yeah, it's been a long time. It's been a long time. Tim, when you and I spoke on Friday, we were sort of talking about how the close might shape out, how this week could shake out with the Fed and options expiration on Friday and all that. With all that, with last week in the mirror, just what is your take on last week in general?
Well, first of all, Happy New Year. I haven't had a chance to say that to you guys yet.
And
Yeah, Tim, man, it's been a long time. We miss you.
After January 15th, saying Happy New Year doesn't count, but I'm going to do it anyway. I missed you guys too. Good to see you.
Great to see you too, Tim.
Well, thank you. And I'd love to kick Kohl's around too. And by the way, so Blackwell's has this, is putting pressure on Peloton. Over on the corporate side of the business, we helped SuperValue through the Blackwell's battle that ended up in its acquisition by United Foods. So we know those folks pretty well. And there's all kinds of that going on at the moment. But Spencer, back to your opening salvo, and we talked about this on Friday about and big volume. By the way, big volume, yes, but the trade size has collapsed. The trade size in the S&P 500 right now is 102 shares, barely off the bid. Right, the number of trades per day in the S&P 500, the average component has gone from a 50-day average of about 39,000 per day. You think about that, traders. They're at least 39,000 prices every day for the typical component of the S&P 500, not counting all the canceled trades. And it's about a 5-to-1 ratio. Now it's 53,000 trades. And so the trade size has come down to 102 shares. That's part of why there's an explosion in volume. So you have to think about that, what that means from the standpoint of who's responsible for it. The smaller the trade size, the more that people who don't want to own things are setting them. Just keep that in mind. Spencer,
it's all traders. I mean, you're exactly right here, Tim. And I'm trading actively here too. And I've been saying on the show, I am that person because I'm buying, selling. I'm doing a little bit of arbitrage. I'm doing a lot of statistical arbitrage, which is what I do in my trading account. But I'm like net neutral all the time. I'm market neutral. Now, my long-term account, I wear two hats. I do have some investments, and they're getting hammered today here as well. But I play that active role of I don't want to own anything. Now, I don't want direct market exposure here in my trading account. I'm just trying to extract alpha from little market inefficiencies. And it's on my job to say, oh, I'm going to buy this and I'm going to hold on to this for a week and a half and make some money. It's a different style of trading.
Right. Yep.
There's a lot more of what I'm doing going on right now, is what you're saying.
Sure, absolutely there is. Now, there's no question there was there was a little bit of, I would call it, panic through options expirations last week. Remember, and this is what we talked about, Spencer. Wednesday, Thursday, Friday were all options expiration dates. And if you go back through the intervening time between now and the financial crisis, the amount of time that the market's troubles coincide with options expirations is a startling correlation. It's almost always those periods. It can be month end as well, but we should be asking ourselves why. Why is it that there's a predictable point in time where trouble seems to develop? And I sent a market desk note out, as we do every day, for Edge subscribers, and we talked about managing risk. Could we have known that the market would decline 9% in the past 2 weeks? No. Could we have known that the market would likely decline? Yes. And it's math. Spencer, you and I talked about the referencing Albert Einstein, who said, don't worry about your math problems. I assure you, my problems with math are much larger than yours. But the market has a math problem. When there is big volatility into options expirations, then prices that depend on future events become uncertain. And the instruments that represent them can be marked to zero. And if those instruments are 20% of the market, you could face real trouble. Now, and here's what we think about from an edge perspective and market structure perspective, that the market trades between 4 and 6 most of the time on a 10-point scale. And calculating, I did this before the show here. I went back and checked the math. If we go back the past to December 2017, just happens to be the data set that I looked at, from December 2017 through Friday, what are the market's gains in total when broad market sentiment is above 6.5? Zero. There are 0% gains cumulatively over the whole time. And January 5, broad market sentiment was at 7.5 and peaked. So if I run the math and say, well, what happens to the market when it's at 7.5? Well, it goes down substantially. So could we have known? Well, yeah. But the hard part for traders is to accept that there is risk in the markets. We always want to be in there doing something. And from our perspective, we always say take gains, not chances. You want to think about, I think, Dennis, what you said. This is a great time to be in value stocks, even for cash preservation. There will be time to leave. But to me, Spencer, the problem was this, that since the pandemic, there has been a flood of money into growth stocks, so much so that the demand could not be satisfied with stocks. So it gets pushed into things that substitute for stocks, options, futures, ETFs, which only have value if the market continues to go up. If it goes down into the first expirations period of the year, you can have real trouble. And that's what we have.
So, Tim, we look at this market here, and everybody, even though there's trouble, even though the risk is higher, it's this natural human tendency to see stocks getting cheaper and say, I want to buy them. I want to jump in here. Exactly. Tell us, is there a chance here? Like, what's your system telling us? Is this going to be over soon? Because it was, in the S&Ps is not that bad, but in the average stock being down 25% here, it's kind of ugly. Is there an opportunity to start dipping our toe in here?
Well, I would answer that with two things. One, think about context, and two, think about supply and demand. Those two things should tell us when or if we do something. So the context, let's take that first. Today, new options trade. So last week we had VIX expirations Wednesday. Thursday were index options expirations. Notice that the deterioration came in the afternoon. So those lapse at noon Eastern time. And everything was uncertain. Market's up, market's down, market's up. We get to noon, boom, it falls over. So that tells me there was a lack of demand for the substitutes that index investors use. Friday, we had the full triple witch, plus LEAPS, long-term equity anticipation securities that expired and reset. Today, we have a whole new series that expires in February. Will money show up? Tomorrow, the banks back an awful lot of that. The large banks, Morgan Stanley, JP Morgan, Goldman Sachs, Citi, Merrill, they back 95% of the derivatives market. So what do they do on Tuesday to square their books? Did we make money? Did we lose money? Let's sort it out. So the context is, let's get through those rapids and see where we are. Then I want to look at supply and demand. Demand's abysmal across the market. Broad market sentiment is at 4.7. It's not at 1. It's at 4.7 and declining. And the supply side, short volume, is above the 5, 20, 50, and 200-day levels. So supply is abysmal and demand is abysmal. When supply begins to decline, I think that's when we have an opportunity. And that's pretty apparent in the data. So that's how we think about it, Dennis. And I can show you if you like.
Yeah, show us, please.
So I was going to ask, so where is that playing out right now? I mean, we saw a couple of charts on Friday, but I'd be curious to see.
Right. We could look at things like Netflix or AMD. Where's the supply and demand?
Start with Netflix because this was basically the catalyst for the sell-off Friday, and the selling has continued here. I mean, we're retesting Friday's lows here. We're only $4 off of it right now. But here's a stock that's widely owned, falls over 100 points on a disappointing earnings report here, and everybody says, well, I'm buying Netflix. At least not everybody, but there's a lot of people on my timeline, my Twitter timeline, saying, I'm buying Netflix because how can I go wrong? Eventually it's coming back. Tell us, what you think out here on Netflix, so what you're seeing.
Okay, so we default, let me hide this because Spencer, you'll mock me if I don't. So I've hidden that now.
Thank you.
So first thing, let's just look at 30 trading days. One of the things that we have learned over time, shorten the time frame to look at it because traders and investors change their minds. They do. Not, you say long-term they don't. Well, but everybody who has managed accounts, I'm like you, Dennis, I've got long-term positions that are managed by financial advisors. We will recalibrate periodically what the exposure is. From a trading standpoint, though, you want to know with fair certainty what the short-term supply-demand equation is. So let's start with 30 days. This is Netflix. This is closing price. And it's not giving us a lot of granularity. That's fine. We just want to know what the demand behind that is, and that's the green part of the graph. And the more time that stocks spend above 5, the better they do. It is a very, very high statistical correlation. So look at what Netflix was doing before it reported results. It was already miserable. It was already a 1, and the supply side is on a ramp up. And right before it reported, supply shot above the trend, telling us traders shorted it. So there was no demand and everybody short Netflix. You can know that beforehand, so you shouldn't be in it. Right now, what we want to see, and we see just the beginnings of it, is a decline on the supply side. If supply drops below the trend, like here, and demand is still at 1, that could be an entry point. But unless and until that happens, it's not. And it doesn't matter where the price goes. It's very easy to forget that price gives you no indication of value. What gives you an indication of value is supply and demand. It's the most basic economic principle. If you got an MBA, you know this. I didn't, but I know this. Supply and demand form the nexus where price lies. Price should be at the nexus of supply and demand. So right now, we know that it will be very difficult for Netflix to sustainably rise until supply declines.
Yeah, this is not making me feel great, Tim. So
we're looking here and I'm like, I don't know what to say.
So okay, wait. Let's just do this. Let's look at a couple names that are due to report this week. We have a lot of big ones. Let's just start with Microsoft because they report tomorrow.
And I think the last conversation we had here, Dennis, you said let's look at Microsoft and Apple.
Yeah.
And we looked at a long range, and I said materially long range. There's nothing wrong with them. And I would still say that, but you can see how supply and demand have weakened here near term. So here, once again, price is the top line. Demand, which is an algorithm. It's an algorithm looking at the underlying reasons that people and machines buy and sell stocks and how that's affecting price. And once again, think about this nexus of 5. The more time that we spend above 5, the better. Well, back here, when it was spending more time above 5 and supply was below the trend, then price rose. But this has been, it's not terrible, Spencer. It's not terrible. But look at the demand is only at what we're at 3.4, and supply is rising. It's below trend. That tells us that Microsoft is not likely to collapse, but this is not a great setup. We back up. What would a great setup look like?
Yeah, give us one because you're making us. We need to cheer us up here. Is there something looking healthy here?
GE or something? I don't know.
I don't know if GE looks healthy either.
I don't know.
We can look at some stuff that is worth buying. But here's where there was great opportunity. When demand shot up and supply did not keep pace, that divergence, supply demand divergence, that's what you want. And when those things converge, when demand stops rising and supply increases, we'll leave. You can repeat that over and over and over. It won't be perfect, but it's better than everything else, as Winston Churchill said of democracy. Worst form of government in the world, except for all the others. So that's what you want to look for. As to what would be good now, we talked about this Friday. One of the things I don't like to trade during options expirations because I think it's just very risky. But if you look at Pepsi, here's a great example of something to own during periods like this. It spent all of its time the past 30 days at 5 or better. And here, supply dropped. So supply dropped into options expirations. Well, traders, that's very telling. You can always look at that ahead of options expirations and go, let's find the stuff that's spending a lot of time at 5 with declining supply. And you'll find the stuff that looks like Pepsi. Pepsi offered a great harbor. I traded it last week again versus the market because of the supply-demand divergence, even though supply or demand is just at 5. And so
you know what else is helping Pepsi, and especially this morning? It's in the queues. And that helps it because we have the Qs trading down 1.48%, but you got Tesla trading down 5%. That's a big ding. You got Google trading down 2.25%. That's a ding. You got Amazon down another 2.5%. That's a ding. You got majority of the big components in the the Qs trading down farther than 1.5%, and that makes them have to buy something. So what do? They buy all those non-tech components of the QQQs, and this will be interesting to you, Tim. If you bring these up this morning, here's your non-tech components. I got them right on my screen. Pepsi, oh, it's green. WBA, oh, it's green. Mondelez, oh, it's green this morning. CSX, what the hell's CSX doing in the Qs? I don't know, but it's in there, and it's trading up 1% this morning. Why is CSX up? I'll get somebody from the media calling me, on somebody. Why are all these stocks trading up? It's the ETF effects. I do the arbitrage, so I understand this. It all has to add up. Yes, so you got CSX, Dollar Tree, Fox, Gilead, Comcast. Why is Comcast up so much today? Because it's in the Qs. That's that's all of how much the ETF effects on this market are amazing.
They're huge.
It's and you follow this stuff too, Tim.
Yes,
this moves markets more than anything.
Yep.
And this only works when the funds are prohibitively large, like SPY, QQQ, and a handful of others.
Because there's a bazillion people doing the ARBs.
Yeah, clearly there's 85% of market cap is in the S&P 500, so there an awful lot of it is going to be focused there. Yeah. But the principle applies to anything. That you've just uncovered the whole basis of how ETFs are priced. People think, well, they're priced on the basis of assets. No, they're not. They're priced on trading an ETF versus the basket that the ETF sponsor wants people to use as a proxy. That's what it is. So if wherever the basket is relative to the ETF is the trade. That is the truth of the matter. So you're right. But the new traders, you can know. You can know where the money using Edge. You want to look at supply and demand, and you will see that. You don't have to be as sophisticated as Dennis, who knows a great deal. You're very fortunate to be able to listen to Dennis on this program every day. But you can look at the supply demand divergence, and you'll see where the money's going. Where's the money going to go in a market like this, low volatility and arbitrage trades?
All right, Tim, we got to let you go. We'll talk to you next Monday. Have a good rest of the week.
Good to see you guys.
We're glad you're back. We missed you.
Well, I'm happy to be back. I mean, I love floating around on a boat in the Caribbean, and I love hanging out here in Austin, Texas. A rainy day in Austin, Texas, but I really love hanging out with you guys.
All right, All right, have a good one, Tim.